Hey guys, welcome to my second lesson in my Asset Allocation course. For this lesson, I would like to talk about the valuation of Southwest Airlines. Now, please keep in mind that the process that we're going through here is a general approach. We could talk about Coca-Cola, Nike, or basically any other company that you can think of. This is more the process of how to look at individual stocks, because what we saw in the earlier video in lesson 1 was that if the American stock market is priced at, call it 3.5%, we can get a higher return, or we can hope to get a higher return from individual stock picking. But how do you estimate the expected return of a stock? So that's basically what we're going through, and we're going through some of the different factors that you can look into when analyzing a stock, so it's easy for you to compare it to a bond or any other kind of investment that you might also be looking at. The first thing I'd like to say is that we always need to relate something to the price of a stock. Let's talk about the airline industry. The airline industry has for good reason been hated by value investors for decades. And when I say good reasons, it is definitely good reasons. You can count the number of bankrupt airlines in the hundreds easily. You have high capital expenditures, you have labor unions, you name it. All the things that you as a stock investor might say, this is something that would create uncertainty, a really bad track record. This is not something I'd like to be invested in. You would definitely have good reasons not to like this, but something happened. And this happened in the last quarter of 2016. Warren Buffett and other respected value investors like Bill Miller suddenly bought into 4 major airlines in the US, despite all the problems that we always hear about airlines. And clearly, whenever I saw that, I was thinking, what is going on? This is not supposed to happen. This is really what happened. The airline industry has become more and more concentrated over the years. This is not good for consumers. When the industry is concentrated, it basically means that there's less competition. While that is not good for consumers because it typically means higher prices, it's very good for stock investors because they are the owners of the company and they reap the benefit regarding higher dividend and higher capital gains on the portfolio. Really, to understand this, let's talk about the different types of markets. Let me provide the example of restaurants in a food court. In a food court, the prices vary slightly. And even if one person might want Italian food and another person a burger, or you might even see 2 different Italian restaurants competing next to each other with slightly different products. If you think about it, restaurants do not have a lot of pricing power. As soon as they raise prices, people will just eat another place. There are so many competitors out there, and knowing that the barrier of entry for new restaurants is just so low, basically everyone can go into that industry. Restaurants in the food court, that's a tough industry to be in. In other words, to make a decent profit, you really need to be able to differentiate yourself and to create barriers of entry. And if we still talk about food, something like McDonald's would be top of the class. They have great business, but interesting enough, it's not because of the food. That's not really where they make the money. They do that through real estate and through branding. They have pricing power that allow for somewhat higher margins, at least for food, which is not necessarily high, but it's still a fierce industry to compete in. Looking at airlines, you might argue that it's very similar product that you have between airlines. After all, you go from point A to point B, right? And if Southwest Airlines raises the price, another company would just hold a steady price and capture market share, right? Well, it's not that simple in the airline business. That is bad for you as a consumer, but it's great for you as an investor. In the airline industry, you have so-called hub cities. So if you're in Dallas or Fort Worth, you will likely fly American. If you're in New York, New Jersey, you would typically fly United. And Chicago and other mega cities, you have these hubs for Southwest Airlines or Atlanta for Delta. And these huge airlines, they have the best point in time of the day to fly, and it can be difficult to find competing airlines. So again, less competition means that you'll have higher prices, which is good for you as a stock investor. Think about how much an airline would gain from raising the prices, especially if you don't have other options. Say the price of a ticket is $100 and the cost is $80. Basically, the gross profit would then be $20. But if you just raise the price to $120, you would have doubled your gross profit from selling that one ticket. So that just tells you something about how impactful it is. One of the ways to think of the new competitive situation is really to look at some of the key factors in the industry. Let's talk about the load factor first. The load factor is basically how many seats in the plane do we fill per mile. Now, this is the load factor for North America. As you can see, it's getting very, very interesting. Over the past 15 years, it has gone up from in the 70s to the 80s. I mean, this is really, really huge. And whenever you go up from a load factor in the 70s to the 80s, it's not a corresponding increase in profit. It's actually a lot more. Almost all the cost of the flight, fuel, staff, depreciation of the aircraft, it's all the same regardless of how many people on the aircraft. Sure, it's slightly more expensive to serve food for a few more people, but it's almost the same. The biggest expense is really for operating that plane in itself. So that increase in the load factor is really almost all profit. Let's continue talking more about some of the industry-specific indicators. The price of oil constitutes between 15 and 30% of operating expenses in the airline industry. And this is really a key change in the business and the landscape of oil and how that has changed. A key change in the business and the landscape of the oil price and the way it has been changed is really because of the oil sands and the fracking in North America. You just have so much more supply that's been released into the market, and even though that the oil price is extremely volatile and goes up and goes down, you just generally see a shift that has been to the advantage of the airline business. If you have a fundamental shift in your cost for any business, that will go back and benefit the shareholders. There are also other factors I would like to point out here that really has a big impact on the profitability for you as a stock investor. One of them is that the old contracts are running out for the current staff. So back in the days, the contracts were extremely lucrative. Actually, they were so lucrative that the generation now that is about to retire and has started to retire, they're making 3 times as much as if you were hired today. They just had very, very different contracts. Contracts that couldn't be changed or they only be changed slightly with all the restructuring. That is running out now for Southwest Airlines, but also for other airlines. Another interesting thing is that the US does not have privately owned airports. Now, this can change, but it means that whenever you see this demand pouring in, you can't necessarily meet that with supply, which basically means that you will have higher prices. You just see a mismatch here. And even if it weren't to be allowed to build a huge airport and they couldn't even find the real estate to build these huge airports around the bigger cities, it would still take a lot of time to plan out. What we see right now is just more demand than supply, and that's beneficial for you as a stock investor. The point here thus far is not to say this is the winner in the airline industry. The point of what we talked about until now in terms of looking at the industry-specific indicators, that is to say, we're looking to get as much tailwind as we can. If this is generally a good industry, yes, then we want to be invested in that industry. And then we can look at, okay, do we have a specific stock in mind that we think might even outperform the industry? The stock I would like to talk about is Southwest Airlines. The stock ticker is LOV. And after Delta Airlines, it has the second highest market cap of airlines in the US. Southwest Airlines operates primarily in the United States and in nearby international markets. And for the 44th consecutive year, the company has been profitable. That is just unheard of in the airline business. One of the things I would like to talk about specifically for Southwest Airlines is the very unique culture. They have this saying that they rank employees first, customers second, and shareholders third. And they say that by treating the employees right, they will treat the customers right, and in turn, that will result in higher profits for the business. I know that something like culture sounds very intangible, but if we look at the next slide here, you will see the customer satisfaction. And this is customer satisfaction for whenever it comes to the aircraft itself, boarding, baggage, flight crew, everything. And you will just see this is not just a snapshot. Southwest Airlines, time and time again, is just top of the class whenever it comes to customer satisfaction. And I think it boils down to how they treat their employees and then in turn how the employees treat the customers. And it's just very, very hard to change customer satisfaction because to do that, you will need to change the culture of the business, which is just very, very difficult to do. So let's look at some of the numbers. So these are some of the numbers that I'm looking at whenever I'm analyzing a stock. I won't go through all of them, but I will highlight a few things for you to look at. The first thing I look at is the revenue, which you see up here. The revenue has just shown a very, very good trend. And even though Southwest Airlines has also been making minor acquisitions, they are primarily growing organically. You don't necessarily want to buy into a company who has to buy competitor after competitor to grow. They should have a business model that just works really well for them and then grow based on that. You can just see the top line, the revenue, everything trickles down for the revenue. A growing top line is really one of the things that you should be looking at. Next, I'll look at the margins, and I both look at the gross margin and the operating margin. And as you can see here, over the recent years, you have seen generally that they have improved. A lot of that has to do with the oil prices that we talked about before, which is just so fundamental to the cost. Remember, historically, it's between 15 and 30% of the cost, so it has a dramatic impact. Remember, the margins are how much money are they making off the top line, which again is why it's so important that you have a growing top line. So let's look at how much money is returned to you as a shareholder. This is the free cash flow. The free cash flow can be returned back many different ways. Generally, you can look at the dividend, what you see up here, and you can see a very nice increase. It's buying back shares. As you can see here, the shares outstanding are less and less. Basically, it means that the earnings that you have are allocated to fewer stocks. So for you owning one stock, you would get a higher portion of the income. And it's also reinvesting that money back in the business, which can be used for higher top line growth, more and more revenue coming in. Generally, you see a very healthy trend in the free cash flow. Okay, so having all these numbers in mind, let's go into our intrinsic value calculator. This is a calculator we use here on the Masters podcast, and I'll be sure to make a link here to the video in terms of where you can find it and learn more about it. But this is more to show you what kind of process can you go through to find the expected return of a stock. The numbers that you see up here, that is the free cash flow that we talked about before, which is basically returned back to you as a shareholder. We are going to input our historical data. Then we have to come up with 3 different scenarios. So we have a high growth scenario, a most likely scenario, and a least likely. Then we had to look at what will happen in the future. One thing is what happened in the past. That's all well and good, and they can explain a lot of things, but what is really going to happen in the future? So we have 3 different scenarios that we each assign a likelihood of happening. I chose 10%, 5%, and 0%. Depending on your stock, depending on your analysis, even of Southwest Airlines too, you might come up with something that is different. As you can see here in our model, we start with around 1800. That was our starting point. If we scroll up, we can see this is the last input that we had. This is the free cash flow for 2017. We can change that if we want to. We could say, what is a more normalized free cash flow? It gets a bit more tricky if we do that. But if we go in and look more about the specific company, and if we say, well, there have been some deferred taxes, they've been investing heavily in the fleet, the free cash flow is probably a bit higher. It's completely up to you if instead of 1800, you would say, 2 billion, perhaps slightly more. But you need to have a starting point. So let's just use the historical data here and say it's around 1800. And then we can talk about the 3 different cases. So if we start with our base case or most likely, what do we expect to happen? Well, if we look at what some of the research shows, demand is expected to stay strong. In general, US airline traffic is expected to increase by more than 3% annually for the next 15 years. And demand is increasing based on improving living standards, increasing population, and airlines continue to add new routes in underserved markets. Another thing is that Southwest Airlines will not only capture US air travel, but they're also expanding international right now. We've seen revenue growth over the past 10 years of 8% annually for Southwest Airlines and very little declining margins. So keeping all that in mind, I used 5% here. Again, if you want to use 3%, 4%, 6%, it's really up to you. I decided to use 5%. I find it somewhat conservative, but I like to be conservative. And I assigned it a 50% probability. Now, let's talk about the high growth case. So for the high growth case here, I chose 10%. I assigned it a probability of 25. So What should happen for this to materialize? We have seen double-digit growth in the net income for Southwest Airlines for the past 10 years. We're looking at how much money is returned back to you as a shareholder. We're not looking at anything else than that. And we're trying to come up with a projection. Another case here why you would see a higher growth for a company like Southwest Airlines is that you will see with the new generation, with millennials, business and leisure are just more and more tied together. They travel a lot. They go on a lot of vacations. They bring their work with them on their workations, as some people call it. We just see this general trend here. So that might be one of the reasons why you see high growth. You have a new competitive situation, as we saw in the beginning of this video, that might even worsen for the consumer. But again, that is good for you as a shareholder, with higher prices on tickets and more profits for you as a shareholder. Southwest Airlines' international presence is still relatively small. Currently, it only represents 4% of the revenue. It is a growing segment. It's up more than 69% in just 2 years, and it's a huge focus point for Southwest Airlines. Even though that the load factor, again, that is how many seats you're filling per miles, even though their margins are slightly lower, this is a very interesting point where I do expect Southwest Airlines to become more profitable. So that is our high growth case. Again, 10%, you might use a different number. I use 10% and a likelihood of 25. My lower band that you see up here, I chose that to be completely flat. I think that is likely. I assigned it 25%. I don't think it's highly likely. And this is not just looking at how has it been historically. If you look at all that tailwinds that you have, not just from the business itself, but from the industry as such, this would really be a very pessimistic view. I see the risk of a negative growth in the years ahead as highly unlikely. Again, if you want to be more conservative, you can say -5, -3, whatever you want to do. 0% for me is a conservative estimate. So if you look at that here at the bottom of the calculator, you're inputting how many shares that are outstanding. You're looking at what's the current price of the common stock. Again, that changes all the time. Then you come up with an expected return of 6.8%. Regardless of Southwest Airlines or whatever company you're looking at, is a great company or not, you have to consider at what price. Because if the stock was trading at $30, you would suddenly have an expected rate of return of 13. It's the same company, it's just a much more attractive investment. If instead the price was $80, it's not an attractive stock anymore, and you'll probably not really outperform the general stock market with a company like Southwest Airlines. This is not a buy recommendation of Southwest Airlines at all. This is not the opposite either. I'm showing you this calculator and talking about the industry-specific indicators, the company-specific indicators, to give you an idea of how do you estimate the intrinsic value of stock. So whenever you are constructing your portfolio, you have an idea of what kind of return can I expect and which asset classes should I even have in my portfolio. I hope that this second lesson and the Asset Allocation Course series was useful for you.